This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Paul Martin with Investor Connect. Today we're here with Nathan McDonald of Keiretsu Capital. Nathan, thank you for joining us.
Yeah, glad to be with you.
So let's go and kick off with, how did you get into the venture capital investing world?
Yeah, it's pretty much what I've spent my whole career on. I was fortunate to do a research project on angel investing while I was still in college at the University of Washington and the entrepreneurship program there, watching companies go public left and right during the dot-com craze back in the late 90s. So I was keenly interested in understanding how to get onto the frontier and find out, how does this whole thing work? How does venture capital work? How do angel investors get together and find opportunities? I was just kind of fascinated by the whole market, which seemed to be, obviously very inefficient, and depending on who you knew and where you were, much kind of different odds of success in it. So through our research into the formation of formal and informal angel groups here in the Seattle area, we got a chance to interview about 25 different business angels, and it was just fascinating to hear their stories on the deals they were involved with and how they accessed opportunities and where they saw the angel investing landscape going, during the internet boom of the time. And we had a lot of old school investors and then a lot of interesting new tech investors, and there's just a lot happening at the time during the dot-com days. And so learned a lot from that project, learned that kind of everybody had a different idea about how things happened and how deals came together, and there was a real need to create a nexus to be able to have different groups and different silos be able to exchange deal flow and information. And also through that, just learning the history of angel investing here in the Northwest, the Seattle area, really learning about the different industries and where they came from and who backed them, and just a lot of fascinating stories, a lot of great content that hooked me early in my career. And so I said, well, let's see what we can do to make a go of it. So I had learned how to put on pretty good events and activities in college and brought that to the networking scene at the time and partnered up with a few other organizations and ultimately put on a big event to bring together all the different angel groups here in the Northwest region. We had 300 investors. It was the biggest event of its kind at the time, and 15 companies which presented and went on to raise over $30 million in capital within a couple weeks after the event. So that was my big introduction to angel investing, kind of the first year or so of my career, and have kept it going since to try and build community around angel investing, build efficiency around it, try to figure out how to make it work better. And it's been a great, fun ride. Every day is different. Every day is exciting. Get to meet lots of great people and really enjoy it.
So you're with Keiretsu Capital now. For those who don't know them, can you give just a brief introduction to the group and then talk about what they invest in? What do they look for in startups?
So Keiretsu Capital is an outgrowth of our efforts within the angel community for Keiretsu Forum. Keiretsu Forum is an angel investment membership group, and Keiretsu Capital is an investment fund manager. So different business models. Keiretsu Capital's mission is to syndicate opportunities, give access to deal flow, and create investment liquidity for our members and for our portfolio companies and our investors. So Keiretsu Capital is kind of the latest and greatest way we've been able to advance the professionalization of the angel investment community, building on many, many years of hard work to get to the point where we're able to originate enough deal flow that meets our minimum criteria. And the deals we back are ones that have been backed by sophisticated angel investor groups, including Keiretsu Forum, but not exclusively limited to that. We also backed deals that are originated by other sophisticated angel groups that do due diligence in a comparable way to Keiretsu. So we look for companies that are backed by angels, due diligence completed, and then we're a top-off fund. So for each of our co-investment funds looks to invest in 40 to 50 opportunities over a couple-year period that meet those criteria, spread across life science and technology and hardware and clean tech and other types of opportunities that are also being backed by the angels. So our key indicator in origination is the angel due diligence, the angel backing, and then being able to top off and bring them to our family office network and our other syndication partners.
And what's some of the key criteria you look for that an entrepreneur should meet before they would consider going through it?
So for Keiretsu Capital, they'd have to have existing angel backing from a sophisticated group. In order to get to that point within the angel group construct, really need to be at that go-to-market stage, be backed by sophisticated entrepreneurs, have raised some capital, be ready to go to market. That's really where the due diligence process focuses in on, is that go-to-market strategy. Obviously, life science is a little different depending on whether it's a medical device or the FDA approval route, if it's a pharma product. So we like to look at anything that has high growth and good return potential. But typically the opportunities we ultimately go with are ones that originated through our membership group, through other sophisticated angel groups. And so Keiretsu Capital itself, we take our deal flow in from those partner syndication organizations, and then we work them through our process to invest and then syndicate them further and ultimately work to create liquidity for those investments for the angels and for ourselves.
I understand you recently established a program to generate more liquidity through more exits. Can you tell us more about that initiative?
So it's been a lot of work to get to the point where we've achieved the recognition from PitchBook and the National Venture Capital Association as the most active investment group globally the last few years, Keiretsu Capital. But obviously that's only so sustainable if we're not generating exit returns alongside our originating of new investment opportunities, and also very important for Keiretsu Capital that the expectations of our fund investors and deliver returns. So it's been my experience working with angel investors for 18 years now that they come in, they're very excited, they make investments, they're very active for usually 3 or 4 years, but then eventually a bit of burnout sets in and they get a little tired of putting in all this time, energy, money, and obviously the companies that are going to fail fast, and so typically you get losses first and gains come much later. So it can take a lot of stamina to stay with it, and it can be difficult to persevere, particularly if we have an economic cycle that we go through at the same time. So in an effort to try and speed up, we've looked at the research for how to be better angel investors and having good experience and good due diligence done to begin with. But then also we've looked at the research, which has been pioneered by Basil Peters, one of our founding members of our Keiretsu Vancouver chapter. And he spent his career the last 6-8 years looking at what does it take to get more exits from angel-backed companies. And he's come up with a lot of great content and educational information for angels to be able to understand where each of their portfolio companies are in their life cycle and what the optimum point is to exit that opportunity. And obviously anything past the exit point results in a lot of time and effort spent that we never get back, and typically results in a financial loss relative to what we could have had. And his research shows that if the companies miss that optimum exit window, that the most likely result is actually the company fails after a lot more time and effort. And I think anyone who's been an angel investor for any period of time has got some opportunities in their portfolio that, in hindsight, looking back at, we realize we doubled down when we should have been selling. And so trying to go through and have a scalable process for evaluating each of our portfolio companies and doing an exit assessment every 6 months and identifying where they are on the curve and educating the board and the CEO as to where the trends of the market are. And again, depending on the technology and the product and the market opportunity, they may be more or less impacted by those kind of factors. But ultimately, we want to try and get a lot more information so that we can help get a lot more exits faster and realize return and recycle that capital for the benefit of the entrepreneur and for the benefit of our investors.
How do you find the portfolio companies working with you on this process? Oftentimes, they're not looking for investors getting out. They're looking to get to the final exit for their company, and they're not looking for people to take the angel's place. How do you get the entrepreneur to be a part of that process for early exits?
And that's where the workbook really comes in and the quick assessment. So our goal is to, in the initial due diligence, obviously, when we're making our investment exit strategy, exit potential is a key part of why angels write checks. And if they believe there's a likelihood there, then that's where they fund. We want to continue that process forward. So the original go-to-market evaluation and exit strategy is intended to be kind of a living document where we can continue to update that part of the due diligence every 3 months, every 6 months as needed to be able to make good informed decisions. So by trying to keep it efficient, the CEOs as part of our group that we've spoken with about the program so far, and we've got about 6 companies in pilot phase right now on it. We'll be rolling it out to the rest of our companies over the next 60 days. They want to spend more time talking about exit, but they find that most of their time is spent on the day-to-day of what needs to get done and not as much on keeping their eye on the overall market. And that's where bringing in our investment bankers, our capital markets team, and being able to really understand what the liquidity options are for the company depending on their stage of development. And what happens is that oftentimes the entrepreneurs have one idea of where they need to build the company to be able to sell it. And typically that's very different from the reality of when companies will buy and how much they'll pay. The result is that it's actually a lot less time and work to get to a higher exit point than what they would otherwise believe. And so that's very motivating. If people can get 2 or 3 years of their life back and make 2 or 3 times more money than they otherwise would, I think people will take that all day long.
Well, some businesses are growing very well and they're on the path to a nice exit. Others fail soon, as you mentioned. And then the third option is the ones that get halfway up the curve and then they turn into a lifestyle business. And it's a good business for them. And the last thing the entrepreneur wants to see is for this show to be over. They want to keep going forever, even though the investor may not be getting an exit either way, good or bad. And so now you can potentially, as an investor, be in this deal 5, 10, 15, 20 years. How do you handle those lifestyle business situations, or walking dead, as some like to call them?
Yeah, I wish we had a great answer to that. And this is kind of the closest thing we have to it, is try to not allow them to get into that phase to begin with. My wife and I, we've got an angel investment we made back in 2006 that's, going on 12 years here, and they're up to $30 million in revenue. And they just finally did relieve the founder and bring in a new CEO to try and grow it and sell it after going through a process this last year. But those are tough situations because as angels, we have a lot of patience, and then we kind of lose track of things, and these aren't typically huge investments we're making. So, we give the entrepreneurs a lot of leeway and a lot of patience. And so we think that's not a very viable strategy, really, and that we need to be a lot more aggressive and proactive in supporting the companies through that initial cycle and really put the pressure on the company to realize some type of return without letting it slide into kind of a lifestyle thing. Or, hey, if that's the way it's going to go, that's fine, but let's come up with some kind of a transaction to at least get people their capital back, at least be driving towards something versus just continuing to pay out whatever revenue comes in the form of management salaries without really seeing any growth. So, they're not great situations to be in. At least it's not but if we can return capital faster in those situations and then get that capital recycling, that's hopefully about the best outcome we can try and facilitate. And those aren't going to be big transactions, and most investment banks aren't interested in them. But our exit team and our angels are very interested in trying to create a better result there. So there is a lot of motivation to try and achieve something versus just see it go along and may or may not turn into something without some kind of actual event being manifested. So not a great answer to that question yet, but we've got some things we're going to try and hopefully get a little better result on a few of my portfolio companies that are stuck in that. So I'm very motivated to see if we can do a little something different, and hopefully it'll work better to reduce the failure rate. The lack of return rate from angel investing is 60-70%. So, with whatever percent are those walking dead opportunities, if we can at least get 1 to 2x capital back off of those, then hey, that's better than minus 1x.
Let me use redemption rights in the term sheet up front. You buy me back after 5 years at some price. How successful do you think that technique is?
Well, negotiating some kind of a financing return strategy, I think, can be good. It's always hard to project, when we're making the investment. That's obviously not the goal, but incorporating some terms along those lines to at least put a placeholder in there, I think, can be helpful. But that's obviously nobody's expectation when we're making these investments, at least most of the time. We're better off just converting it to debt, paying back the debt, if that's where we end up with. But unfortunately, prescribing that early on, you don't have the information of where it's going to be 3 or 4 or 5 years down the road to be able to really dictate what that structure is going to be. So regardless of whether you have it in there at the beginning or it's negotiated later, I think, ultimately you've got to come up with a resolution, and have the want to get capital back to the early investors and respect the fact that they backed the company and got it going and figure out some means of getting some return back to that initial group and, value their contribution.
I find to control or influence these discussions, you really have to have invested a certain amount of funding, or a certain percent of the funding has to come from you or your group. And when you have three people that put in 10K checks each, they really aren't going to exert much influence over any of these discussions. How do you get a controlled position without having to put a huge amount of money into a deal in order to influence this process one way or the other?
Yeah, this is definitely one of the major drawbacks of the angel community and having fragmented investors that have a limited economic interest in any one deal, because we want to be diverse, makes it very challenging. And that's why we created Keiretsu Capital, to be able to aggregate that capital together in a way that allows us to invest and top off the opportunities that have the most investor backing and have relationship with many of the investors as a part of that. So we can act, since we have full-time staff and we have professional managers, so we can act on the best interest of our fund investment, but we can also take into account best interest of the angel investors, of which we value highly as well. So having more co-investment funds, having more active angel investment managers in the ecosystem is very productive to organizing and aligning those interests in a way that allows the group to be able to have some ability to have a seat at the table, and also trying to make sure we have representation from the investment group on the board and good investor relations communications between the investors and the company. So getting good financial information on a regular basis with an update continues to be a pet peeve and a real challenge for our angel portfolio. I'd say 80% of the companies report well, but even with all the due diligence and everything we go through, there's still probably 20% that we wish they would do a much better job of updating us on their status and what we can do to help.
One of the jobs of the board of directors, and in the early days they don't have boards, but usually later they do, but one of the jobs is to drive the exit. What's your experience with board of directors on the companies you've dealt with or see go through the angel network or the Keiretsu Capital? Are they effective? Are they not effective? Or what's your take on that?
Well, my take is it's real hit and miss. And in some cases, they're terrific and they're going to take care of it themselves, and that's great. But 10% of the deals that deliver 80, 90% of the return, they're usually full speed ahead and they're well governed, well run, and ready to rock. What's the other 60, 70% of the deals that don't quite have that support, don't quite have that representation on the board, where we think we can have a difference by connecting up those companies and try to train the board members on how to be more proactive and more effective at talking about what the exit strategy and bringing in the right advisors for the board and advisors for the company to be able to make sure they're pursuing all the options available to them in the market. And what we found is that there's just a real disconnect between the entrepreneurial investor and the CEO and the capital markets in general. They're generally not talking to each other very much, and if they don't have existing advisors, the chances of them somehow miraculously coming up with them is very low. So that's why we are putting together our exit advisory team of 30, 40, 50 certified exit advisors that can be on call and match up per company to make sure they are getting the attention and the board's getting the support it needs to be able to make better decisions. And we think we can get a better result through that effort. We're going to give it a go here and check back. Our goal is to have one exit a month this year and hopefully 2 exits a month starting next year. So we're going to track the results and know pretty quickly whether the effort is paying off or not.
Well, that sounds great. One last question, and then we'll see if you had any further thoughts, is are you formally engaging those advisors, or is that an informal network of like a board of advisors where we get feedback and brainstorm and that type of thing? How formal is that relationship?
Well, it's informal to start in terms of the initial assessment and giving people a chance to just get introduced to each other and explore whether they want to work together or not. And ultimately, it's up to the company to consult and advise with, who they want to work with. We just want them working with somebody or hopefully multiple somebodies that are qualified to provide that kind of support. But ultimately, it is up to the company and the board side if they're interested in working with some of the folks on our exit team, or if they want to go out and find other exit advisors, that's great too. So we don't try and force anything on everybody, but we are trying to use a bit of a carrot and stick approach to at least get the conversation started and be able to give them access to hopefully some top quality talent that otherwise they may not get a chance to interact with.
Great. Well, the final moments we have here, what else should we talk about that we didn't cover on this program?
So the course of my career here in angel investing, 18 years now, it's been a fascinating journey, a lot of fun. I find a lot of people are interested in angel investing. I've watched Shark Tank or other type of kind of media programs or listen to podcasts, but actually diving in, getting in deep requires a bit of an extra entrepreneurial passion and fortitude. But do encourage people to, join your local angel group, get access to some deal flow, learn about best practices around due diligence and supporting companies. And then if folks are interested in learning more about Keiretsu or Keiretsu Capital or our different programs, we have a lot of educational content at KeiretsuForum.tv or Keiretsu Capital or KeiretsuForum.com. And encourage people to come check out if they're interested in attending an event or getting to know more about our funds or different investment strategies that we have. Happy to make any education available that people can hopefully dive in, get involved, and support however they can.
That's great. What's the best way for listeners to get in touch with you?
My email is Nathan at Keiretsu Forum or Nathan at Keiretsu Capital, depending on folks who are more interested in the capital or the forum side of things. Take a look at our website. And then I'm very active on LinkedIn as well. I have a pretty nice network, and we'll be at the ACA events here this next week in Boston. So happy to look anybody up who might be attending that or any of our Angel Expos or other events that we do every month. So always great to connect with people if they're able to attend one of the gatherings that we're participating in.
Great. Well, thank you for joining us today and hope to have you back soon to discuss further these topics and more. So appreciate your taking time today.
Yeah, of course. Great to be with you and appreciate the opportunity. Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.